So this is the question that we had to do for that makeup tutorial in capital budgeting. So the question there you can see on the screen is just sampled out from a paper, 2016 Managerial Finance Test 2. Tusha Limited is considering expanding its production of a new product called hoops. The plant is expected to cost 10 million and have a useful life of 4 years with zero salvage value. It will be ready for operation in 1 year. Then about 1 million has been spent on the products. Okay, so this is the following information. You got about 4 years. That's the useful life they've told you of this particular investment. Okay, sales, they've told us that there is the cost, but the cost includes depreciation. So of course the deep value is not yet known, but we just know that it's in that cost value. And then profit before tax, okay, given as well there. Okay, what else do we have? Then tax rates, 80% depreciation has been calculated on straight line basis, so we would have to just come and prove to know which dip is in there because of that scenario where we have to add it back to make it a cash flow. So I'll demonstrate. Prepare a statement showing the incremental cash flows of the project relevant to a decision concerning whether or not to proceed with the construction of the new plant. If the relevant discount rate is 10%, should Tusha take on the project? So first of all, we want to determine whether you can accept or not this project. So the best technique to use is the net present value when you're evaluating any project. So look at the details. Initial outlay has to be calculated if it's net present value we're going with, as we have just stated. And we also need the present value of the cash flows. Now, these details here, are they the cash flows yet? No, because the cash flows themselves are determined after you have prepared something like a profit statement. Like in our case, we have sales. So the moment you see things like sales, costs, the first thing is prepare a profit statement that will end up resulting into net income. It's from that net income that you can now derive a benefit from or a cash flow. So the first step is determine net income. So you just look at the question. So the trick is that, okay, if you see maybe sales, you're also seeing maybe costs and the like, the best approach would be prepare a profit statement, just like they're even asking in the question. So let me just demonstrate this, and I'll now show you how this solution should be done. So what you're going to do is this. It's just like you're creating a capital structure. Sales less costs or variable costs. Now they've just said costs, so just say costs. When you less your cost, you should get EBIT. Okay, but the fact that you're dealing with an investment that undergoes some form of depreciation, like they talked about, this is no longer called EBIT but EBITDA. Okay, just remember that. Then of course dip should be subtracted. Then you now go where EBIT, then interest out, then you go where I've just continued the table this side, EBT, tax out, and net income. This is the one we're talking about, the net income. It's from the net income now that you can start talking about a cash flow. So when you're given sales, okay, sales for the period were those. The best way you can calculate a cash flow is creating a statement just like this. And then when you reach net income, what next? Add back depreciation. That's what you should remember. So deep, first of all, as we prepare, you should just remember your 120. How do you prepare a profit or loss statement? Depreciation is first subtracted. Now when you're coming to now determine a cash flow, you have to get that dip which you subtracted initially, you have to add it back. That's the rule there. So just remember this, and this is how you prepare the profit statement to determine your cash flows. Okay, so those cash flows, once determined, what do you do? Okay, what you're going to do is this. In our case, they said depreciation is included in the costs. So I want us to move together here. Depreciation is moved in the cost. So remember what you're seeing on the screen. I'm just going to change a bit based on what we have. Usually, as we said, sales less costs should give us what? EBIT. We put DA because of the depreciation part, because of looking at an asset being invested in. Now, DIP is already in the cost. So, in short, just for this scenario, we will not put EBITDA. Why? Because the DIP is taken care of in the cost, like they'll be subtracted together. So hence, when we just subtract sales less that cost, including DIP, we just end the on EBIT itself. So in short, what should just be left with this. Just for this scenario. Otherwise, if DIP is not included in the cost, follow the first approach or the format I've just shown you. That's how you do it. So DIP, they just told us, okay, just for rough sake, just for knowledge sake, the cost of this entire investment is 10 million to last for 4 years, and they said it's on a straight line basis. How do you find depreciation on a straight line basis? It's cost less salvage, which is 0, over number of years, which is 4. This will give you 2.5. That is the DIP charge, but they've just told us, okay, it's in there in the cost. So let's just go with the actual cost figure, just less, because we know there's already DIP in there of 2.5, which will come and need at the end. Well, we come to add it back. So we just need to know it, because there's a time when you need to come and add it back to make that figure you get as net income a cash flow. So we just have to know it now. So what I'm going to do is now I'm going to share a screen showing you the initial outlay calculation and how you're going to determine this cash flow via the profit statements. Then of course I'll show you whether you can accept the project using the net present value technique. Okay, so move step by step there. So we are starting with initial outlay. So initial outlay, pick out the cost of this investment. Okay, since you so just initial outlay itself, as you can see, 10 million is the cost. The initial cost, you take it into consideration, and then WC is just working capital. I just abbreviated that. You add the two. This is what your initial outlay is equal to. That's all. Your initial outlay is the most simplest part of your capital budgeting calculation. You do by all means to get this part right, because you would score a mark just to get initial outlay correct. So just make sure you polish this up. Then now, annual benefits. Annual benefits, okay, annual benefits, as we said, these are just like cash flows that you'll be benefiting from your investment. Now, how do you get them? So hence, this is the calculation. They told us prepare profit statements. I showed you the trick to know that you're supposed to do this. If you've seen things like sales costs for the period, those just know that, okay, I'm supposed to prepare a profit statement like what you're now seeing here. This one had years, so we also respect the years: year 1, year 2, year 3, year 4. So if they've given you a year type of scenario, follow the years like that. They will have listed them. Okay, so and each year had its own sales, although year 2 to 4 had the same. That was the only good part. Yeah, but sometimes things are different. Yeah, so it's just our scenario here. So sales less costs, yeah, do that. You get EBIT. As I said, it would have been EBITDA, but the reason why we ended here is that DIP is already included in the cost, so it's like it's already taken care of there, and they're already going to be all being subtracted at one point there. Then EBIT, there's no interest in the question. Then you go to EBT. EBT tax. Tax is at 30%. Why do you charge tax? Tax is charged on EBT. Just remember that. So it gives you those figures for each year. Charge 30% on each year's EBT. Then you'll be getting those figures for tax. Once you're done with tax, what's next? Net income. Then you're done with your capital structure or your profit statement. What next? Would you say the net income is your cash flow? No. To make it a cash flow now, that income, which would call our benefits, we have to add back depreciation. That's the rule. Add back DIP. Once you add back depreciation, then now you know that, okay, it's now a cash flow, the figure that I get after that. So this is how you make sure that after you prepare your profit statement, always remember that if DIP has been talked about in a paragraph, please add back. So those are your values. You're done there. You found your cash flows, which they didn't say after tax cash flows because they've gone through tax, as we've seen there. Then next, let's go to the net present value technique, which requires us to bring these cash flows to the present. Look at what I've done. Year 1 we had 39. Huh? Yeah, if you go to year 1, the one column, yeah, we had 39 as the cash flow. Interest factor, go to your interest factor table. Year 1, this is year 1 specifically. Interest factor table, which one? PVIF. Follow how I've pronounced that. Huh? PVIF. That's the table you go to. Under 10%, they told us. You find this figure. Multiply the two, you get that figure in the PV column. In the year, the next one, in the year column, we said 2 to 4. What are we referring to? Well, years 2 to 4 has the same cash flow. That's why I just combined them. Years 2 to 4 has the same cash flow. So what you just do there is that you just sum up the interest factors from year 2, year 3, and year 4. Just sum up those, because we're taking them into consideration as they are one fixed cash flow from year 2 to 4. Hence, they'll have to have an accumulated interest factor value. That's how you should know that. So when you're taking something that's fixed, you just sum them up together. Not just go and pick the interest factor in year 4. That would be wrong. Because if you go and pick the one in year 4, it's like you're saying year 1 is also included, but no, this is just from 2 to 4. Because those values on the annuity table, they actually, when you go to the annuity, they consider figures as of from the first to the particular year that you're picking. So this one started in year 2 to 4, and since it has started like in between a period, in between maybe a particular period like 2 to something, the best is going to get just individual interest rates from the PVIF table. Get for year 2, get for year 3, and 4, add them up, and then you put, since we are combining them already 2 to 4, then you just put the figure since it's fixed, and you go ahead like that. 4, well, whatever I just put on 4 there alone, that's supposed to be working capital. The same working capital you had in initial outlay, the rule is that you should come and repeat it under your cash flows as well, why it's supposed to be recovered at the end of the useful life. That's why you have to put it like that. And in year 4, what's the interest factor just in year 4? That's the figure there, the factor there, 0.6830. They're done. Multiply, you find the present value, and this is your present value of the cash flows, the 14,354,510. Net present value is equal to that. Present value of the cash flow minus initial outlay, you should land to that particular figure or amount. Okay, so basically this is how you approach this question. So capital budgeting comes in many fashions. Just understand the topic, what it comprises of, how the question has been phrased, and how you can even approach it.